Well, welcome to session 4. In this session, we're going to be talking about some of the basics behind the options market, but go over some basic options terms that you need to be familiar with. Although option trading is based on stock movements, there are a number of factors that are unique just to options that you need to have a good understanding of in order to use them successfully. Uh, in this session, we're going to talk about the items that you need to build a foundation of knowledge, not only to understand how options work, but also how to use them for any of the different strategies you can use as an options trader, and also specifically as they relate to the Rebel income system. An option is a contractual agreement between two parties. The contract covers a predetermined amount of time and includes an agreement to either buy or sell the stock underlying the option at a predetermined price. A single option contract, remember, gives the buyer the ability to control 100 shares of a stock without committing the resources necessary to buy those shares. So let's use a real estate example to show how this works. Let's suppose that you found a home that you'd like to buy. You like the property, the neighborhood, and the price. Now, you'll probably have to take out a mortgage to buy it, and that takes time. And since it does, you give the seller an offer sheet with the price you want to pay for the house, along with some earnest money, which is a fraction of the total price of the home. If the seller accepts your offer, keeps the earnest money, you have control of the house for as long as your offer sheet specifies you'd need in order to secure your mortgage. You control the house, but you don't actually own it yet. Options work in essentially the same fashion. When you buy an option, you buy the right to buy or sell the stock underlying the option at a set price for a set amount of time. So for an option buyer, just as with your offer sheet, the option gives you control of the underlying stock without actually owning it. For the seller, selling options works in a similar way as with the offer sheet as well. You get an initial payment up front for for selling somebody else the right to act on that asset, in this case the stock, the underlying stock, at some point in the future. Now, it might sound simplistic to say that for every option buyer, there's also a seller. Keep in mind, though, that that because of the types of different types of options that can be used, buyers and sellers fill different roles. And it's important, no matter what your option strategy is, to be familiar with the roles that buyers and sellers each take. The first thing to remember is that option buyers pay for the right to buy or sell the stock associated with the option at some point in the future. Option sellers, on the other hand, are being paid to give that right to the buyer. So that creates an obligation to fill the terms of the contract that they've sold. So to put the role of each of these individuals to put the role that each of these individuals play in the options market a little bit more clear, let's take a look at the two types of options that can be traded. Let's talk about calls, and then we'll talk about puts. So as always, the buyer has the right to sell, the seller has the obligation to buy or sell. Now, when a buyer clicks a call option, he pays for the right to buy the underlying stock at a set price at some date in the future. Since he paid the ask price, buyers always buy at the ask. He has the choice whether he's going to buy the stock or not. There's no requirement or obligation for him to do it. Because the seller receives immediate payment by selling the call, the seller accepts the potential of being obligated to sell the stock if the call buyer should decide to enforce the contract. When we're talking about put options, buying a put option gives the buyer the same right or choice of whether to enforce the terms of the contract. The difference in this case is that the put option buyer will have bought the right to sell the stock at a fixed price at some point in the future. Also, the seller accepts a potential obligation. The difference now is instead of being forced to sell the stock to the call option buyer, the the seller of a put option, uh, it could be required or obligated to buy the stock from the put option buyer. The seller of any option, call or put, can't back out of the agreement once the buyer decides to enforce the contract. Now, knowing how buyers and sellers fit into the construction of an option trade makes it a little bit easier to understand why each side of the trade, uh, each side of an option trade, a buyer and a seller, take the positions that they do. The table that I've got on this slide is designed to give us a visual representation for the attitude of each side of an option trade. So let's take a look at each one for a call and a put trade. For a trader that buys a call option, having the right to buy the stock means that in order to be profitable, the stock has to move up. Let's suppose that you bought a call option with a stock buying price of $25 per share attached to it. 2 weeks later, the stock is trading at $30 per share. The the call option buyer, you in this case, uh, would be able to buy the stock for only $25 and keep the $5 difference between 30 and 25 if you want to sell out of the stock, or to hang on to the stock and continue to hope that it continues to go up. Of course, in this case, that means that the call seller is going to be forced to sell the stock for $5 less than the current price. So that begs a question. Why would somebody want to enter that kind of an agreement? The answer lies on a couple of different levels, but one of the most fundamental reasons is simply in the different ways that traders interpret market data. Where the buyer thought that the stock would go up, the seller's opinion was that the stock would go down. Selling an option with a buying price of $25 means that if the stock goes below $25 as the seller expected, the buyer would have no incentive to act on the contract. The seller would keep the money he was paid for the sale, and he's free to do it again. So a call buyer sentiment towards the underlying stock is bullish, while the seller's sentiment is obviously bearish. Now, for a put option, since the buyer has the right to sell the stock, his preference is going to be for the stock to go down. That means that if the stock selling price for the put option is $25 and the stock is $20 per share 2 weeks later, the put buyer can buy the stock at the current market rate, then turn around and sell the stock to the put seller for $25. Again, pocketing the difference between the stock's current price and 25. That's why the put buyer sentiment towards the underlying stock is bearish, whereas for the put seller, their sentiment is bullish. They are expecting that instead of going down, that the stock is going to go up. If it stays above $25, the buyer has no incentive to buy the stock at the current market price, 27, 28, 30, 35, whatever the price may be, and then selling the stock to the put option seller for $25. Remember that no matter what your outlook for a stock's price is, whether you think it's going to go up or go down, there's always going to be somebody else who is willing to take the opposite side. So while the put buyer is betting the stock is going to drop, put seller is betting that the stock will go up. Notice that the buyer of a call, the seller of a put, both have the same bullish attitude about the stock, while the put buyer and the call seller are equally bearish. The difference between the two is the potential for each trade. For the buyer, the potential profit is much higher, while for the seller, The maximum profit is fixed and set to the amount received at the inception of the trade. In the Rebel income system, we focus on being sellers rather than buyers. The primary reason for that lies in the probability of success of different trading styles. Time has proven over and over again that option buyers lose far more frequently than they win over time, between 70 to 70% of the time, in fact. Now, if we think about that from the perspective of an option seller, that means that if buyers are wrong 75% of the time, sellers are right 75% of the time. The potential profit for the seller is smaller on a per trade basis, but the increased probability of success means that sellers on average tend to see far better results in the long term. That's why we've built the Rebel income system to focus on the sell side of the options market rather than the buying side. Now, anytime you buy a security, whether it is a stock, an option, or any other kind of security, futures, whatever, you will always buy at the ask price. Selling is always done at the bid price. In the options market, the amount paid by a buyer or received by a seller is often referred to as the premium. All contracts include a price at which the underlying stock can be bought or sold. This is called the strike price. Keep in mind that the strike price isn't referring to the cost of the option itself, but the price used for buying or selling the stock underlying the option. An important part of your options analysis will include evaluating different strike prices for suitability in the trade you want to make. An option strike price you'll see included in a price quote. For example, on the screen here, I've listed a November 25 call. 25 is the strike price in this case. Since this is a call option, that means that the option buyer could buy the underlying stock for $25, while the seller could be required to sell the stock at $25. Along with the strike price, every option contract also carries a fixed length of time with it. This period of time is called the expiration date. There's two different expiration types, monthly and weekly. Monthly options are the most common and are set to expire on a standard basis on the third Friday of the month that they are listed. In the example above our expiration dates here, we have NOV for November 25 call. That means that this is a monthly option that expires on the third Friday of November. Weekly options, on the other hand, will expire on the Friday of the week indicated. So on the weekly options line here, you can see I've expanded the example. Instead of November 25 call, we have a November week 2. When you see the week number included, you can infer that you're looking at a weekly option. NOV is an abbreviation for November, meaning that this particular option would expire on the second Friday of November. Once that second Friday has passed, the expiration means that the option basically goes away. If you hold an option through its expiration date and the underlying stock hasn't moved past the strike price that the buyer purchased, the option is going to expire worthless. For the buyer, that means that they'll lose all the money they paid to set up the trade, while the seller simply keeps the premium that was brought in when the trade was placed, and they have no obligation that they need to fulfill. Now, I've talked a couple of times already to the fact that the buyer of an option contract has the right to act on the terms of the contract. This act is referred to as an options exercise. Now, let's suppose just for a moment that before the second Friday of November, the buyer of our November 25 call in the example that you see listed here sees the underlying stock is now trading at $30. is she could decide to exercise her call, meaning that she'll tell her broker that she wants to exercise the contract. The broker will then buy the stock from the option seller for $25 and deposit the shares in her account. She can then decide whether or not she wants to sell out of those shares, take the profit, or hang on to the shares and wait for the stock to continue to go higher. For the call option seller, this transaction of exercising the call option is described as being called out of the stock. Now, on the put side, uh, there's some similarities and some differences. For the put buyer, the choice is the same. The put buyer still has an opportunity to choose to exercise the put option. That then forces the put seller to buy the stock. Their obligation is to buy the stock from the put option buyer at the contract strike price. For a put option seller, this transaction is called an assignment. Let's suppose that instead of a November 25 call, the buyer bought a November week 225 put. If the stock is trading at $20 before the second Friday of November, the buyer of the put option can decide to exercise her put. That means that she'll buy the stock at the market's current price of $20 and then sell the stock to the put option seller at 25. She gets to keep the difference between 25 and 20, while the put seller owns the stock at a purchase price of $25. You may be wondering why a put option seller may want to be willing to accept this kind of an obligation. This is one of the elements of the Rebel income system that we've built in, is an understanding that sometimes assignments happen. That means that when we analyze a stock, if you think back to if you think back to session 2, when we went over some of the fundamental metrics and the valuation analysis that we perform, what we're really looking for are stocks that are available at deep discounts. We're looking for opportunities to acquire undervalued stocks at attractive prices. What this means is that using put selling is not only a way to generate immediate income from the sale of the put option itself, but it also sets up an opportunity to buy stocks that we like at prices that we believe represent useful values. That means that even in this example, if the stock is at $20, if my analysis strongly suggests that the stock should be worth more than the $25 I was assigned, I won't be afraid to accept that assignment. There are variations on a theme, and some put option sellers prefer not to be assigned, and that is when taking actions like buying the call option back, or excuse me, buying the put option back from the market becomes appropriate. But in terms of the way that you see me write about the Rebel income system and the put selling trades that I publish on our website, you will see that that put assignments are something that I don't shy away from, and I use my put selling system as a gateway to stock ownership so that I can acquire shares and build an investing portfolio of stocks that I like at deeply discounted prices. All right, moving on. When you get a quote for an option contract, you're going to see several additional pieces of information along with the contract's ask, bid, and last prices. I'll show you an example of that in a few minutes. Before we do get to that though, among these, you're going to notice open interest and volume. These are numbers that give you a way to measure not only how actively the option is being traded, but also to get a general sense for how much speculation may be going on. Open interest describes how many contracts of a given expiration and strike price are available to be bought or sold. Now, these are not the same as volume, which describes how many contracts have actually changed hands in a given day. Open interest instead is simply letting you know how many contracts could be bought or sold. The higher the number in open interest, the faster a trade on that contract is likely to be filled. The other aspect of open interest and volume that is important to note is that the highest levels of both items are often on the most speculative or risky option contracts available. In an option chain, you'll often see the highest trading volume and open interest with out of the money contracts that are multiple strike prices away from the stock's current price. As a trader, you should be careful about using these contracts because they can be fool's gold, since the extremely high numbers simply mean that there's a lot of speculation around those contracts. These are often the contracts that result in unsuccessful trades, especially for buyers, either because the stock didn't move the direction the trader wanted or it didn't move enough in the time allowed. The best guideline for open interest and volume is to make sure that you're working with options with at least 50 contracts in open interest that are near the money or slightly in the money. This ensures that there is relatively enough liquidity in those options to be able to place a trade, and that way you can be confident that your order is going to be filled as quickly as possible. Leverage is a term that isn't used to measure any aspect of an option contract, but rather to the fact that option prices tend to move more than the prices of their underlying stock. Now, there are some ways to measure the amount of leverage in a contract, which we'll discuss in our next session. For now, suffice it to say that leverage means that you get more bang for your buck when you buy an option instead of the underlying stock. The stock moves 10%, for example, you may see 25, 30%, 50%, maybe even a 100% increase in the options that are tied to that stock. Let's use an example to illustrate what I mean. Let's suppose you're thinking about buying a stock with a current price of $30. If the stock increases in value by a single dollar, your return on the investment would be 3.3%. Now, that's not too bad, especially if the stock moves quickly. But what if you could buy an option on the same stock for $4 per share? That option might move 60 cents for every $1 the stock moves. The same move in the stock from $30 to $31 per share might mean that you could make a 15% return on your option investment, which is easily superior to the 3% the stock gave. Now, that sounds really nice, and that does mean that when you're correct as an option buyer, that you can stand to make more money. But leverage also cuts both ways for buyers. If the stock drops to $29, you would also lose 15% in the option as well, whereas in the stock you'd only lose 3.3%. Leverage when it comes to rebel income is really not so much of a consideration. Since we're taking the selling side of the transaction, this idea of leverage doesn't give us as much to work with as, as other elements that we'll be talking about in this session and in the next one. But just keep this idea of leverage in mind, because this is one of the things that attracts people to the buying side of the options market. When they are right, it often means that they are far more right than they would have been if they simply worked with the stock itself. Remember that as soon as the expiration date of an option passes, the option effectively disappears. That means that any value that remained in the option also disappears. This is a fact that makes it relatively easy to understand that each day an option gets closer to expiration, it not only loses time, but also a portion of its value associated with that time. Time decay, like leverage, is a term that refers to the deterioration of a stock's price the closer to expiration an option is. In our next session, we'll talk about ways to measure the rate of deterioration in an option due to time decay. Right now, I want to emphasize the impact that time decay can have on a trade. Let's suppose that you bought the $4 option a moment ago with a December expiration date, and the stock doesn't move higher or lower than $30 for the next 3 weeks. Not only does the option lose 3 weeks of value, but the option would actually need to move farther than it would have 3 weeks earlier to be profitable. This reality increases the chance for a losing trade for an option buyer, which increases the reason for the buying and selling guidelines that we talk about. If you're going to buy an option, for example, we strongly recommend buying more time than you think you need. When we're talking about option selling, as you can see here, we emphasize selling as little time as possible. No matter how quickly you think a stock's price is going to move, if you're buying an option, make sure you follow this buying time more time than you think you need guideline. If you're selling an option to initiate a trade, time is on your side. So it works to your advantage to sell as little time as you can. Since Rebel Income is built around being an option seller, time decay is an element that provides an advantage to our system. In fact, I think of time decay as an option seller as being the counterpart that leverage, as being the equalizer for the selling side of the transaction that leverage provides for the option buyer. Rebel Income trades focus on options that expire within 1 month or less because time decay accelerates the closer to expiration an option contract is. That helps to increase the probability of success in our put selling trades even more than sellers who work with longer periods of time. It also increases the frequency of trades that we can place, which improves long-term results by taking in more premiums over shorter periods of time. When you have a list of option contracts in front of you, it can be hard to evaluate the different contracts and determine which would work best for the trade you want to make. To some extent, this depends on the option strategy you intend to use, but before you tackle those elements, first you need to know how to relate an option contract to the underlying stock's current price. Now, any option can be categorized as at the money, in the money, or out of the money. These terms simply refer to whether exercising for a buyer a given option contract would result in owning a stock with positive or negative equity. At the money simply refers to the strike price that is closest to the underlying stock's current price. Now, the stock price may not match the strike price exactly. It only needs to be the closest of all available strike prices. In the money, on the other hand, refers to any contract that would result in a positive equity position if it were exercised. For example, if you buy a call option with a $25 strike price and the underlying stock is currently priced at $28, you would have $3 in equity, so the option would be in the money. If you're buying options, in the money options are considered to be more conservative. The deeper in the money you go, the more conservative the trade is. Thus, a call option on our $28 stock with a $20 strike price would be more conservative than the $25 strike price, since there's $5 more in equity to work with. Out of the money refers to any contract that would result in a negative equity position if the buyer were to exercise it. Using our $28 strike price, a call option with a $30 strike price would be out of the money, just as the $35 strike price. For option buyers, out of the money options are very aggressive and involve a much higher level of risk than in the money options. When we're talking about being option sellers, which is what the Rebel Income system emphasizes, we really are flipping the conservative versus aggressive script when it comes to in the money and out of the money options. With Rebel Income, we emphasize using out of the money options to place more conservative, higher probability trades. in the money options in the case of being the seller is generally considered to be a bit more aggressive because you're selling a contract with a strike price that is already above. If we're talking about selling a put option, you're selling a strike price that is already above the stock's current price. So you are you are already looking at a potential obligation should the option buyer decide to exercise it. The graph that I've listed on this slide gives you a visual cue for some of the concepts that we've just talked about. For calls, any strike price, and this is true whether you're an option buyer or a seller, for calls, any strike price that is higher than the stock's current price is out of the money. And any strike price that is lower than the stock's current price is in the money. For puts, any strike price that is lower than the stock's current price is out of the money, while any strike price higher than the stock's current price is in the money. What you'll see with Rebel Income is that we do try to emphasize strike prices that are generally at or out of the money. At the money is acceptable if it's also slightly out of the money. If the stock is a little bit higher than the at the money strike price, then sometimes we will use that contract. But the focus, as much as possible with Rebel Income, is to make the trade more conservative by focusing on out of the money options. If we can achieve a desirable result of if our if my monthly target on my income trades is 1.5%, for example, and I can get 2% by going at the money, or 1.5% by going 2 strike prices out of the money, then I will often choose to go 2 strike prices out of the money in order to make the trade a little bit more conservative and hopefully increase the odds of a successful trade. Now, becoming comfortable at identifying in the money, at the money, or out of the money options is something that takes everybody time and repetition, some experience. The great thing about the way that most brokers operate today is that it actually help to make it a little bit easier to get used to differentiating between strike prices by highlighting all in the money options with a light shade. All out of the money strike prices are simply listed with a white background. This makes it relatively easy to see the inverse relationship between the in the money and out of the money contracts for both calls and puts. For the option chain that I've listed on this screen, you can see that if the stock's current price is around $115 and change, the 115 would be the at the money strike price while also being a little bit out of the money. Everything below 113 for put options is also out of the money, while anything above 115 for put options is in the money. On the call side, the 115 may still be the at the money contract if it is the closest to the stock's current price. But since we're now talking about call options, it would now be slightly in the money. So it's going to be highlighted yellow on my screen here, as well as any strike price below 115. While any strike price above 115 will be out of the money, and there will therefore simply be listed with that white background that I was talking about. The best way to get familiar with this is just simply to check out the options that are available for the different stocks that you may be looking at on your broker's website and practice identifying in the money, out the money, and at the money options. All right. I hope this time has been useful for you and that it's helped to lay the groundwork for some of the details you need to be aware of as we get into placing functional income trades. In session 5, we're going to dive into some additional terms and some additional concepts that I like to call options dynamics. We're going to talk about concepts like intrinsic value. we're going to really drill down more into the concept of time value and time decay and talk about how to leverage those in a positive fashion, especially as it relates to rebel income. We'll talk about a stock's volatility and how you can measure what a stock's volatility is and how that relates to the stock's underlying options. We'll also dive into something called the option Greeks. The option Greeks are a set of metrics that are based on various mathematical algorithms that provide ways to estimate some of the elements like time value, time decay, and volatility in ways that can be useful and help to inform effective decision making in the trades that you want to place. Thanks again for your time, as always. Looking forward to talking with you again in session 5.